Hello friends and colleagues, here is how we value a food manufacturing business. So here is a fantastic tool that we use as one method of determining the multiple rate, the capitalized multiple rate that we use to assess a business. And the first part of this process is to first of all define the business by its size of profit, not by its size of revenue, not by its size of employee count, by its size of profit. So you can see here there are 5 different tiers, and this is for the food and beverage manufacturing sector, and this is as at August 2026. So feeding into this data is comparable sales. So there are 5 different tiers. Tier 1 is EBITDA of under 200,000. Then as the business grows, so do the multiple ranges. You will note that under tier 1, the maximum multiple rate would be 2.4 times if the profit is, say, $150,000 or it's less than $200,000. So the maximum multiple rate would be 2.4 times. Tier 2 would go up to 3.2 times, and that's for a profit of between 3 to 500. Then we have a nice, really healthy jump up to a tier 3 size business where you've got a more established business. You've got most likely really organized operational infrastructure, personnel infrastructure, and you generally have a business that has more room for error when it's being transferred. So for businesses between $500,000 and $2 million of profit, the multiple rate goes up to 4.2. Then you've got EBITDA between 2 million and 4 million. And here the multiple rate jumps up really nicely again, up to 5.5 times. And then you have an EBITDA of over 4 million. And this is where you can see multiple rates really climb above 5.5 times. But what we do is we categorize various risk characteristics within the business, and we will then score them below average, average, or above average. And we'd score them individually. We might look at 4 or 5 different risk characteristics, or we might look at 15 to 20 different risk characteristics. Let's have a look at them now as a little bit of an example. And for the purposes of this exercise, I'm going to work with a tier 3 business, which most of our clients fall within. They have profit between 500,000 and 2 million. So let's look at the characteristics. And this is just as a little bit of an example. So you can see here that the below average score is up to 2 times. Average is up to 3.2 times, and above average is 4.2 times. So let's just hypothetically say that this business in the food and manufacturing sector has a net profit between 11 and 20%. And let's say that it's 15%. So I'll probably give this a score of 2.8 out of a possible 4.2. The net profit is incredibly important, so I'm going to give this a weight of importance out of 10 as 10. Then let's move to the next risk characteristic, customers. And the definitions or the criteria are there are substantial dependencies on customer where one customer makes up more than 20% of revenue. If you move this to an above average definition, the customer base is considered diverse. So here we might say that the customer base is considered diverse, which to be honest would probably be a little bit unusual for a food and beverage manufacturing business because they often have some level of customer concentration. But we'll say it's reasonably diverse, and we'll give this a score of 3.9. And this is probably also a very important topic, so we'll weight this as 9 out of 10. Suppliers. The materials products are prone to substantial price fluctuation, or average, the materials products can experience price fluctuation of up to 10%, or above average, the materials products experience minimal price fluctuation and are aligned with CPI or GDP. So I'm going to give this probably a low score because certainly in this sector, materials and raw ingredients have fluctuated a lot in the last 2 years. So I'm going to give this a low score of say 1.7. And it's also a relatively important characteristic. So I'll give this an 8 out of 10. Let's look at premises. The business is difficult to expand at the current premises for a below average criteria. For average, the business can expand by over 50% at the current premises, or the business can double at the current premises. So I might also give this a low score because we'll assume that the business is close to running at its capacity. So I'll give this a score of, let's say, 1.8, and probably in a lower importance, maybe we'll give this a score of, say, 6. And then working capital. The business cannot maintain without immediate capital investment. The business can maintain, however, some capital investment is required to grow the business more than 25%, and the business can grow organically without any further capital investment. So here we'll give this an average score because we can see that the business is close to its capacity at the current premises, and further capital would be needed to grow the business, most likely to purchase more plants and equipment. So we'll give this a score of 2.6, and we'll give this an importance of 8. So what we've got here is we have a very precise and accurate capitalized multiple rate. Now, if you compare this to, say, the process that an accountant might go through, where they will just simply use a very typical rule of thumb approach where they will apply multiples of 3 times to virtually any business, this is able to give us a very, very precise, justified, and relatively objective opinion of what the capitalized multiple rate should be, down to 2 decimal points as well, because if a business is $1 million in profit, there's a really big difference between a 3 times rate and a 2.64 times rate on the fair market value of the business. Now, this isn't an end all. This isn't the only thing that we're going to rely on. What's really important to consider here is this has to be pressure tested. We can't just take a hypothetical desktop objective weighted scoring method and say, this is going to be suitable to then apply this to a valuation and that's it. The next thing we want to do is we want to look at actually what's for sale at market. Looking at comparable sales historically, which a lot of that worksheet is modeled around, is useful. But the thing that is lacking in comparable sales are the transaction terms. You don't really know what eventuated in terms of the transaction terms and what the seller had to provide to reach that sale price. So historical sales are useful, but we also want to benchmark this against what is being offered in the market today. So this is where we would need to look at and do some research and find other businesses that are comparable, that are actually advertised for sale today, so that we can also get a true picture of where this multiple rate that we've determined from a desktop standpoint actually fits into the market. And part of that process means getting on the phone to the brokers, understanding how long the business has been on the market, understanding have any offers come into the business, and actually getting real defensible knowledge. And that part's really hard to do, and a lot of brokers skip that step because, again, it is hard to do, and other brokers have got to be willing to communicate information with you. But look, that's how we value a food and beverage manufacturing business, and that gives you some indications as well of what the multiple rates will be depending on the size of the profit in the business. Hope that was helpful, folks. Thanks for watching.